In Shanghai, silver is trading at $85 per ounce, while Western financial screens still display a much lower number. This is not a temporary spike driven by speculation, emotion, or retail enthusiasm chasing momentum. It is a structural signal, the kind that appears only when the foundation of price discovery begins to crack. Most investors are watching interest rates, inflation prints, and central bank press conferences, completely missing what silver is quietly revealing. Because silver is no longer trading as a single global market with one unified price. Two different prices now exist for the same metal, and they represent two entirely different realities. One price reflects paper contracts, leverage, and financial settlement. The other reflects physical metal, immediate delivery, and industrial necessity. When those two prices separate, history shows the outcome is never calm or orderly. The adjustment phase does not wait for analysts to update models or investors to feel comfortable. It happens suddenly, violently, and permanently, because physical reality always wins in the end. $85 in Shanghai is not an anomaly that can be ignored or explained away. It is a warning that control over the silver market is slipping from traditional pricing centers. And once that control begins to weaken, it rarely returns without extreme disruption. This moment matters far more than most people currently understand. Because silver is not just another commodity fluctuating on a chart. It is a monetary metal, an industrial input, and a strategic resource critical to modern infrastructure. When silver breaks, it exposes deeper problems across the entire financial system. And those problems are now surfacing in real time. To understand why this is happening, you must first understand how different markets treat silver itself. The Shanghai exchanges are designed around physical settlement, not financial abstraction or synthetic exposure. Industrial users participate directly because they require metal delivered for immediate consumption. Refiners, manufacturers, and state-linked entities dominate activity, not hedge funds chasing quarterly returns. When these participants buy silver contracts, they expect physical bars, not cash equivalents. They expect trucks, vault transfers, and metal that can be melted and transformed into real products. In Shanghai, physical settlement is the norm, not an exception buried deep in exchange rules. Western markets operate very differently. COMEX trades silver primarily as a financial instrument, heavily leveraged and rarely delivered. Most contracts are rolled forward, closed out, or settled in cash without any metal ever changing hands. This system functions only as long as physical demand remains patient and unquestioning. It fails the moment physical buyers demand metal now, not promises later. That moment has arrived. Factories are no longer willing to wait for paper markets to resolve shortages on spreadsheets. They are paying higher prices to secure real silver, and that behavior is rewriting the market. For decades, investors were taught that silver had one global price, quoted on screens and repeated endlessly across financial media. That belief worked only because few participants ever demanded physical delivery at meaningful scale. Paper markets thrived by offering exposure without obligation, leverage without inventory, and liquidity without metal. The system expanded quietly, contract by contract, until claims on silver far exceeded the available physical supply. This imbalance remained invisible as long as confidence held and delivery requests stayed minimal. But confidence is not a permanent resource, especially when industrial demand begins accelerating simultaneously. Solar manufacturers, electric vehicle producers, and electronics firms all rely on silver as a non-substitutable input. Unlike financial investors, factories cannot roll contracts or accept cash settlements. They require silver in hand, on schedule, or production lines stop entirely. As demand increased, physical inventories tightened quietly, without headlines or dramatic price movements. Vaults reported adequate stocks, but much of that metal was already pledged, leased, or promised multiple times. The same bar of silver often backed several paper contracts simultaneously. This worked only because no one expected all claims to be honored at once. That assumption is now being challenged. When buyers demand delivery, paper markets face a simple but dangerous test. Either physical silver exists in sufficient quantity, or it does not. There is no accounting adjustment that can create metal where none exists. In recent months, delivery requests have increased steadily, not explosively but persistently. Each request removes flexibility from the system and exposes stress beneath the surface. Premiums for physical silver have risen even when futures prices appeared stable. That divergence signals scarcity long before price charts reflect reality. Retail investors noticed it first, paying higher premiums for coins and bars. Then industrial buyers followed, locking in supply at almost any available price. At that point, paper pricing lost its authority, because the true price is always set by the buyer who needs delivery now. Western exchanges attempted to maintain order by increasing margin requirements and limiting position sizes. These measures slow speculation, but do nothing to create new physical supply. They treat symptoms while ignoring the underlying shortage. As stress builds, exchanges quietly encourage cash settlement over delivery. Cash settlement is presented as flexibility, but it reveals the system's weakness. If silver were plentiful, delivery would not be discouraged. Shanghai does not need such mechanisms because its contracts are built around metal, not leverage. That difference is now visible in pricing behavior. Shanghai prices respond directly to physical demand and inventory constraints. And that is why silver trades dramatically higher there than in paper-driven Western markets. Silver has not always been treated as a commodity, and for most of recorded history, it functioned primarily as money. Empires rose by controlling silver flows and collapsed when that control failed under economic pressure. The Roman Empire relied heavily on silver coinage to pay soldiers, fund expansion, and maintain social stability. As military costs increased, Roman authorities began reducing silver content in coins. This debasement temporarily solved budget problems, but permanently damaged public trust in money. Prices rose, trade slowed, and economic confidence eroded across the empire. Eventually, no decree or punishment could force people to accept debased silver as equal value. History repeated this pattern again and again across different civilizations. In medieval Europe, silver shortages routinely triggered monetary crises and social unrest. Kings clipped coins, altered weights, and blamed merchants for inflation. But manipulation never fixed the underlying scarcity. During the Spanish Empire, vast silver discoveries in the Americas flooded global markets. For a time, abundance created the illusion of endless wealth and imperial dominance. Yet uncontrolled silver flows fueled inflation across Europe and Asia. China, operating on a silver-based monetary system, absorbed massive quantities through trade. Silver became the backbone of global commerce, linking continents for the first time. But even abundance proved unstable when political control failed. Wars, trade disruptions, and corruption eventually fractured the system. Once again, silver exposed the limits of centralized monetary control. Whenever authorities attempted to dictate value without metal, markets pushed back violently. Fast forward to the 20th century, and silver's role shifted dramatically. Paper currencies replaced metal backing, but silver remained embedded within the financial system. Governments maintained strategic stockpiles to stabilize prices and industrial supply. Over time, these reserves were sold, leased, or quietly exhausted. Industrial demand grew, while monetary demand was deliberately suppressed. Price controls, futures markets, and leverage replaced physical discipline. Silver became a tool for managing inflation expectations, rather than reflecting reality. But the metal itself did not change. It remained finite, essential, and increasingly difficult to replace. History shows that when silver is treated purely as a financial abstraction, instability follows. Every monetary system built on confidence alone eventually encounters a physical limit. Silver has always been the metal that reveals that limit. When trust collapses, markets return to tangible assets with intrinsic utility. This transition is rarely smooth, and it never favors those who ignore history. Today's divergence between paper and physical silver echoes every major reset before it. Modern civilization runs on electricity, data, and energy efficiency, and silver sits quietly at the center of all three. Silver is the most electrically conductive metal known, outperforming copper, aluminum, and every commercial alternative. That single property makes silver indispensable across power generation, transmission, and electronic systems worldwide. Solar panels require silver paste to convert sunlight into usable electrical current efficiently. Even small reductions in silver content significantly reduce panel efficiency and lifespan. As global solar capacity expands, silver demand rises in direct proportion. Electric vehicles use far more silver than internal combustion cars. Each vehicle contains silver in battery management systems, power controls, and safety electronics. Grid-scale energy storage further compounds this demand. These systems are not optional, they are mandated by energy transition policies. Artificial intelligence infrastructure adds another layer of silver consumption. Data centers require high-efficiency power distribution, cooling systems, and backup redundancy. Silver ensures minimal energy loss across increasingly dense electronic architectures. Telecommunications, including 5G and satellite networks, depend on silver for signal reliability. Military systems rely on silver for guidance electronics, secure communications, and hardened circuits. These uses are strategic, not discretionary. When silver supply tightens, governments and defense sectors do not reduce consumption. They outbid civilian markets quietly and decisively. This creates invisible shortages long before prices reflect true scarcity. By the time price signals appear, available supply is already committed. Unlike many metals, silver cannot be easily substituted without performance loss. Engineers can reduce silver usage marginally, but elimination is impossible in critical applications. Recycling helps, but recovery rates remain limited and energy-intensive. Much of silver is used in tiny quantities across billions of devices. Once dispersed, it becomes economically unrecoverable. Mining output has stagnated despite rising demand. Most silver is produced as a byproduct of other metals. That means supply cannot respond quickly to higher prices. Even significant price increases fail to unlock new production immediately. This creates a structural imbalance between demand and supply. Markets tend to underestimate shortages that develop slowly. They assume substitution, efficiency gains, or future supply will resolve the problem. But silver's unique properties make those assumptions dangerous. When physical demand accelerates simultaneously across industries, there is no buffer. Inventory drawdowns hide stress until sudden price adjustments become unavoidable. This is how commodities transition from stable pricing to violent repricing. Silver is now entering that transition phase. The market is moving from financial expectations to physical constraints. Once that shift completes, price discovery happens rapidly. And it rarely respects historical price ceilings. Every manipulated market eventually reaches a point where arbitrage no longer functions as a stabilizing force. Arbitrage relies on the assumption that assets can freely move between markets without restriction or delay. When physical silver cannot be sourced quickly, price gaps stop closing. Instead, they widen, exposing the fragility of paper-based pricing mechanisms. Shanghai and Western exchanges now reflect two incompatible market structures. One prioritizes delivery and real consumption, while the other prioritizes liquidity and leverage. As long as metal flowed freely, the system appeared stable. That flow is now constrained by policy, logistics, and strategic stockpiling. Export controls, long-term contracts, and state intervention restrict supply further. Each restriction removes another release valve from the system. Western exchanges respond with rule changes rather than metal. Margin hikes, position limits, and settlement flexibility attempt to suppress volatility. But these measures discourage participation without solving the shortage. Liquidity thins as confidence erodes. When confidence disappears, paper prices lose authority entirely. At that point, futures markets no longer lead price discovery. They follow physical markets reluctantly and violently. This transition has occurred before in other commodities. It always ends with sudden repricing rather than gradual adjustment. Silver is approaching that same inflection point. Analysts debate whether silver can reach $100 per ounce. That question misunderstands how market resets actually occur. Prices do not climb politely when shortages become undeniable. They gap higher as buyers compete for limited supply. In such moments, valuation models become irrelevant. Only availability matters. Industrial users cannot pause production to wait for lower prices. Governments cannot risk supply disruptions in strategic sectors. They will pay whatever price secures metal. That behavior defines the true market price. For investors, this creates both opportunity and danger. Paper exposure may not track physical reality during extreme stress. Premiums, delivery delays, and settlement risk increase simultaneously. Physical holders gain leverage as liquidity evaporates elsewhere. Those relying solely on paper instruments face uncertainty. Silver's role as a monetary signal reasserts itself during systemic stress. It reflects confidence, scarcity, and trust in the broader financial system. When silver finally reprices, it will not be subtle. It will be sudden, disruptive, and widely misunderstood. And afterward, the market will never view silver the same way again.